according to the readings anyway, it began as early as 1850. Britain had an initial position as a large industrial economy. The entrepreneurs were well placed to perceive profitable opportunities in other countries. There were great improvements in transportation and communication in this period, which improved access to markets. And
between 1880 and 1929, we see the global economy is driven by a fall in maritime transport costs and the integration of goods markets.
The fact that the London Stock Exchange matured as an investment area meant that it became an early source of FDI finance. It was a massive conglomeration of information about investment opportunities, so there were a lot of knowledge spillovers there as well. The fact that expertise was inadequate in some senses in developing nations gave British and other Western entrepreneurs an advantage in that they were able to establish industries such as utilities and other infrastructures before domestic entrepreneurs could get there.
The fact that they were forefronting the gold standard meant that they could recycle a lot of the capital that they had. And what they did with that was they invested in social infrastructure projects in emerging markets like India, or in the imperial markets that they had, which had a lot of social returns. You had a big multiplier effect, and it facilitated a lot of international trade.
Which also gave them large markets to send their products to.
We can see in the late 19th century, Europe became a prime exporter of manufactured goods, and the US and colonies were prime exporters of agricultural goods, and there's that reliance on empire markets.
In the interwar period, the increase of protectionism and high tariff barriers gave firms an incentive to invest directly in foreign countries rather than export to them.
And moving on to the 1930s to 1950s, we see that with the Great Depression, there's kind of a fall of GDP, unemployment in the global economy, and the developing world is kind of rejecting FDI as they think is a form of neo-colonialism.
We talked about America and the fact that they had a strong management, a large market, and they had like a knowledge of spillover, and the fact that they had migration in America, which meant that certain industries were exported to America.
The US is the most dynamic foreign investor, and Marshall Aid is a huge contributor of that as well. In 1950 to 1979, 85% of FDI inflows are coming from the US. And currently as well, we can see that with supranational organisations such as WTO, NAFTA, and all these regional trading blocs such as NAFTA are really helping globalisation move forward.
What institutional and infrastructural barriers are going to have stood in the way of development of an internationally successful software business in India in the mid-1980s? That'd be government bureaucracy, things like issuing of patents in technology, tariffs, market size, falling trade barriers, large setup costs of software businesses, costs for research and development, the spread of protectionism, so market size and competitive behaviour.